Hey everybody, Coach D with TackleTrading.com here to talk about options and intrinsic value. Ow, paper cut. Intrinsic value of options contracts is measured by the difference between the market value of the underlying asset and the strike price of the option contract in question. A call option with strike prices below the current market value of the underlying asset will have intrinsic value or equity. A put option, on the other hand, is the opposite. With strike prices higher than the current market value of the underlying asset will have intrinsic value or equity. The portion of the option premium that is based on equity for option contracts that are in the money, out of the money options, have no intrinsic value. In the money options do have intrinsic value. To help us understand intrinsic value, let's use a simple analogy from real estate. Imagine, if you will, if you got a home under contract well below the current market value. You could buy that contract and automatically have built-in equity. On the flip side, if you put a house under contract for a price way above the current market value or above the current market value, you would have no equity. In fact, they might even say you were buying that house and you're going to be upside down in that house because you have no intrinsic value or no equity. A quick look at an options chain with an intrinsic and extrinsic value layout, you can quickly identify the equity or the intrinsic value. Now, first thing we want to state is that in the money options have intrinsic value or equity. And all intrinsic value is the difference between the current price of the underlying asset and the strike price of the option in question. Now, on this options chain, we have calls on the left and puts on the right, and I'm just going to highlight some of the areas that will help you spot the intrinsic value. So here is the stock. We're looking at Apple stock, and the last traded price was $207.55. Now, if we look at the asset columns here, we look at the calls and then the puts, we look at the calls, you can see we have an intrinsic value and an extrinsic value column for the calls. Now, if we look at the $200 strike, and we know that the current price, again, is $207.55, well, then we know that we have $7.55 of intrinsic value. That's intrinsic value. Now, we flip that over on the put side here, and we look over at the put side, and again, we can see those same columns. We got the puts and the intrinsic and extrinsic value columns. And you'll notice on the puts, it's the opposite of the calls. The in-the-money options are down with the higher strike prices, higher than the current asset value. So if you look at, the last traded price of the stock is at $207.55, and you look at even these 210 options, you'll notice that the intrinsic value is $2.45. Well, that's the difference between the strike price and the current price of the stock. So we now understand intrinsic value of options contracts is equity. Again, it's the difference between the current asset price at the market value and the strike price. And if it's in the money, there is intrinsic value.